put some sports drinks, get sponsored by
Yeah.
them. And then
I feel
every
like-
time I'm quenched and my voice is raspy, I take a drink and they're like, product placement. Valuable.
I like that. We just get snack sponsors. We'll give us snacks to do the show.
Or we just fake sponsorship until someone's like, oh my gosh, like they're promoting our product for free, let's actually sponsor them.
I don't know that we can do that as fiduciaries.
You know,
Even if it's not money?
yeah,
Even if it's just
like watch
food?
this, you know, take that, hold it up there, Costco's,
Costco.
Kirkland water bottles, they're just gonna love it.
All right, gang, it is that time of the week. It is time for the True Wealth Radio Show on this, the greatest Tuesday you've had all week. I'm your host, David Littlejohn, and in studio with me today, I have,
Matt Dixon.
but also,
Emma Arndt.
all right, yes, you are.
Yes, I am.
Was that a pun off
Her
the
name
last
sounds
name?
like a contraction, even though it's
It
not.
does. My favorite joke about my name is like, "Aren't you glad I didn't say banana?" And people just, I think a lot of people
You had
don't
to
think
be
it's
there?
funny, but
It is funny.
I've been saying it for 10 years, and I think it's hilarious.
I love it. Okay, well, look, welcome back to the True Wealth Show, everybody. We are always happy to have you tune in, and we are going to probably talk about all of the favorite things that we have again, right? What's been the favorite topic of the last month or so?
Well, AI.
Maybe the last 2 months? It has
The
been
AI
pretty much
revolution.
AI.
Yeah.
Well, oh, good, we have the magic buttons now. And glad we pushed those. So, AI indeed. So, here's the question I want to pose a little different, though. We talk about how AI is going to change the world. We talk about how it's going to change the job landscape in particular. But today, I want to talk about why AI makes math hard.
Mm-hmm.
Okay? And if you're thinking to yourself, wait, shouldn't AI just do the math? Well, maybe a little different kind of math.
And
Okay.
you never trust it when it does math. We've seen that so many times before where you're like, wait a minute, those like numbers do not line up.
I've literally said, hey, what do these numbers add up to? It needs to be 100%. And it's like, yep, everything looks good. And I'm like, I just put it in the spreadsheet. It's totally wrong. And it's like, nope, it's fine. I go, check your math again. And it's like, oh, I'll be darned. It is wrong. Sorry about that. I'm like, seriously? You doubled down on that error.
Oh yeah, I was dealing with that exact same thing today. AI wasn't pulling live data. You have to always tell it, like, please use accurate data because it defaults to sometimes using stuff from like 3 months ago. And you're like, that's not today.
Well, this is all relevant to today's conversation. We're going to get into some of the idiosyncrasies. And if you're thinking to yourself, how does this have anything to do with either my wealth management or it does. More so than you realize, because a lot of what's been driving the macro themes in the marketplace seem to be connected to the proliferation of artificial intelligence.
Mm-hmm.
Like the biggest companies in the S&P 500 now, almost all of them are AI connected companies.
In one way or another. Even, you look at a company like Cat, right? Where it's like, oh, they're making, engines and dozers and all sorts of things. Well, a lot of those are now running on AI where there's a computer inside the cab that's being able to do very, very particular things at a very precise level. So yeah, they're all, in a way, almost.
Well, everything seems tech, for sure.
Yeah.
But the really big companies, Google, Microsoft.
Oh, like the big top 10, yeah.
Even Amazon with all their data centers.
Yeah,
right?
the
You look at
AWS
these-
is a huge tech stack.
And so all of this stuff is very, very AI dependent. And what the market seems to be doing is saying, well, right now we're making, I'll call it a hyper investment in artificial intelligence. Where we are just pouring money into this stuff, oftentimes far faster than these companies are able to actually return profits.
Right. We're kind of speculating on future revenue and earnings and stuff.
Yeah, so let's talk about what that means and why this, I believe, is really relevant. Because for a lot of our listeners are familiar with this, because a lot of listeners that kind of mirror me, or even a little bit older, in our community. I think that there's a lot of younger folks that have really never seen the market get way out over its skis. There's been 18 years since a significant correction.
Mm-hmm.
Right? 2008 was the last significant correction the market experienced. Prior to that was 2000. And for many younger investors, the idea of the dot-com bubble is a history note. They weren't there for it. So it just doesn't resonate as to what that really means. Now, to a lot of our listeners, they were around for the dot-com burst. And so they remember terms like the new economy, or they remember when everybody was saying, well, Warren Buffett's washed out, right? Everybody else is making 40, 50% per year. Warren Buffett's making 9. He's yesterday's news.
Yeah.
And all of that ended up proving out to be verifiably false after the fact.
Mm-hmm.
So what, like Matt,
Yeah.
if I were to ask you to try to explain to our listeners what appears to be going on with AI, how would you describe it?
A greedy frenzy, right? That's the way I look at it. Everyone doesn't want to miss the next big thing. And so everyone seems to be piling in the boat and saying, well, what's the next, kind of NVIDIA, or what's the next Microsoft? What's the next big thing? And people are just throwing money around like crazy trying to grab onto shares of what they believe will be the next big investment.
Yeah, I'm seeing some really fascinating behaviors right now. Here's the other thing. We're hearing about lots of IPOs. Big
Yeah,
talk around
huge, like
IPOs.
the biggest of all time.
Right?
Yeah.
Which that's, I think, SpaceX is projected as the biggest of all time currently.
Yep.
But what are some of the other big IPOs that are being discussed?
There's 2
right now?
more. OpenAI is set to potentially IPO this year, and then Anthropic as well.
Okay, so these are 2 very outspoken public artificial intelligence companies.
Yep.
And then SpaceX is we're going to go to space, right?
Yeah.
The first private sector space company.
And they also have a ton of AI embedded in that too. They're like Colossus is part of SpaceX, the supercomputing for Grok now. So it's gonna IPO, and a lot of people are pretty excited about it.
Yeah. To me, it's fascinating. Of course, I'm not going to get into the
granular
characterizations that come with the Elon Musk ecosystem, and what comes with that center of influence is pretty remarkable.
You know what I think kind of is resonating with people is so many people regret missing out on Tesla, right? Like people didn't own shares of Tesla, so they missed Elon's version 1, and now it's like, oh, he's got another company. This is my chance to grab the next Tesla, and so the buzz is insane.
Yes, I believe that's true. I often say it's about it used to be the shoe shine guy,
Mhm.
which is like no longer a thing. But now it's your Uber driver. That's kind of what I said. Like when you start getting
Right.
stock tips from your Uber driver, it's like, I have news for you. Probably not a tip.
Yeah.
It's like that's pretty
Everyone
broadly
knows
known
about it.
at that point when everybody is talking about it. The question then becomes, is the math right?
Oh man, I'm gonna butcher this. So for everyone listening, throw this out. Don't listen to me. But I heard that the expected IPO on this thing is supposed to value SpaceX similar to like Amazon.
Yeah, it's
But-
like a multi-trillion-dollar company out of the gate.
Yeah, right out of the gate. But if you actually look at like revenue and earnings and stuff, it's just a fraction of what Amazon's stuff is. So it's like, wait, you're gonna value these companies the same with market cap, but they don't earn like 1/10 of the money that.
So, I
It's
think
crazy.
there's a huge misunderstanding out there in the general population about how these things even get valued.
Do you want to talk about that a little bit?
Well, sure, let's talk about the concept of market capitalization.
Mm-hmm.
What do you think that means? When you say market cap,
Yeah,
does
so-
our listener understand that? I think a bunch of our
I
listeners
think we
do,
should
but-
clarify it.
Yeah.
So you take like how many shares that are outstanding, and then you
Mhm.
multiply it by the price that it's trading at, and then that would tell you the value of the company, right? So if there's 100 shares of a company, that's a really low number. But if there's 100 shares and each of them are trading at $5 a share, it's a $500 company.
So I'm going to take this one step further, though. oftentimes the number of shares in circulation is not the same as the number of shares in existence.
That's true. The
So-
companies hold stuff back.
Right. So
Owners
in
hold
this
stuff
case,
back.
it could be that SpaceX decides, hey, we need to raise. Let's say we need to raise $100 billion of capital in order to build the things that we want to build.
Mm-hmm.
Well, you just suggested that the company's valuation is going to be $2 trillion. Well,
Yeah.
100 billion would be roughly 5% of that, if my math is correct. Which means they would only have to sell 5% of the outstanding shares
In order to raise the capital that they need.
at
yeah.
the price of $100 billion,
Mm-hmm.
and that would imply a $2 trillion market value if they fully subscribe, meaning all the shares get sold for the price that they bring them to market for.
Yeah.
And so that's how the company is then presumed to be valued is, well, we sold 5% of the company and everybody was willing to pay this much for it. Therefore, the entire company is implied to be worth what that, and then what happens is that the shares start trading amongst the general population after that. And then what do? We say, well, whatever the last trade is that we saw on the secondary market, that's the stock markets, well, then we assign the last traded value to every single stock out there.
Mm-hmm.
Now, the question is that right? And if you're over there, if you have an opinion, yes, no, or otherwise, I have news for you. Doesn't matter whether or not it's right, it's what happens. That's
true.
how we do it. So it's the last traded price, we impute the value to the entire organization. It's possible, for whatever reason, that somebody was willing to pay a whole lot more than maybe they should have, or that they're not willing to pay that much for it. And that's the question is, well, in the future, will the value still be at or above that price?
Right.
That's what the market's really trying to figure out is, did we get it right?
I think people struggle with the numbers, like putting it like side by side, apples to apples, like the numbers that we're throwing around. Because I heard a report today, we talked about those three, right? SpaceX, OpenAI, and Anthropic. Yeah. And some estimates are showing an expected valuation for the three combined of almost, I think it was like 4.9 trillion combined.
Mm-hmm.
And you look at what is close to that $5 trillion mark as far as just how do you even compare that number to something? Germany's entire GDP is like 5.4 trillion.
Yeah.
So these three companies combined, they're estimating will be worth in value.
Oh,
It's
don't
like
worry. It's
three companies make up Germany's entire economic output.
I want
Put that
you
in perspective.
to hold on to this thought. Okay,
It's wild.
we're gonna go
That
to
is
break
wild.
because of the timing. I want you to hold on to this thought because we're gonna come back and we're gonna talk about what could go wrong. So stick around. I'm Dave Littlejohn,
And Matt Dixon.
And I'm Art.
and you got True Wealth, News Radio 92.9 FM and 1240 KQEN.
That's wild.
That you could sell the
Yeah.
shares and immediately value those three companies as much as Germany's entire
Well,
economy.
but here's the gotcha that we really should be sharing with all of our listeners, not just during the break. The gotcha is if everybody decided simultaneously to sell the shares, there could be more sellers than buyers, at which point the price completely collapses. And let's say that shares go from $100 to $20, that $2 trillion valuation falls to $400 million.
Mhm.
Like
just
in
over,
the blink of an eye.
just like that.
Yeah, or 400 billion, I guess. I was doing the math wrong, but 400 billion, from 2 trillion to 400 billion. So the point is that it is the aggressiveness or the buying or the selling that temporarily determines the market capitalization of the company. That's why valuing stocks is so doggone hard. And that's why Warren Buffett ultimately looked at this and said, yeah, right now you guys think I'm stupid. But eventually people are going to come to their senses and realize these things aren't making money. And you're just buying hype. And when they figure that out, then the tide's going to go out. And all those ships are going to go down as that tide goes out. And as his famous quote is, And it's not until the tide goes out that you see who's skinny dipping. So
That's good.
I really enjoy that perspective from him, because investors are buying value, speculators are buying price. That's my own quote, by the way. We can put that on the internet somewhere, right?
There we
Yeah. I like it.
Who? Matt is looking at something.
go. Mm-hmm.
What
Yeah.
shenanigans are you up to?
I was just curious what they expect the percentage to be of like institutional buys versus retail buys on these IPOs.
There'll be
What is the difference?
some.
What does that mean?
So like BlackRock and Fidelity, like when it comes time to like buy these shares and looking at who actually
Mhm.
owns it, right? Because
All right, gang, welcome back to the True Wealth Radio Show. If you're just joining us, remember you can grab the podcast to get caught up. You can check it out tomorrow. Go to littlejohnfs.com under the Educate tab, and you'll see it in our Knowledge Center. You can also subscribe to your favorite podcast place. Just look up the Little John True Wealth Show, and you'll find it there. So, okay, when we went to break, told our listeners we'd come back because we were just describing how market capitalization works and how a company can be valued super, super high. And then the question was, hey, what could go wrong in this scenario where the market could get it wrong? Or maybe it's not that the market gets it wrong, it's just that the market changes its mind quickly.
mm-hmm.
Okay?
Here-
Walk me through this scenario. We did this during the break, by the way. This is why we're also live streaming on YouTube. So if you want the after hours clips or whatever, then you need to watch that.
Yeah. Well, here's one way that things could change really, really quickly. So if you look at Anthropic, they just posted their first quarter where they were profitable, right? Like they just turned profitable very, very recently. And so the numbers on that company are changing daily, right?
Mhm.
Like they're expecting their revenue to double from 500, what did I say, 500 billion in Q1 or
It
2.
wasn't that high.
I think it was. It was like 400 and something billion, wasn't it?
I think you're talking about. I thought it
Or
was something like
million.
9 billion.
No, it was
for the
million.
quarter.
It was million in
It was
earnings.
550 million of
Earnings.
net earnings.
Net
right? So they
earnings,
have
that's right, yeah.
they have their gross revenue, but their
Yep.
net earnings is at 550, and they expect that to go up to a billion or something.
Right. Yeah. So but they were projecting that it would go basically to $1 billion in quarterly revenue. So that's doubling, right?
Maybe it got up to 10 at the end of the year because
It was-
it was a tenth of Apple basically.
That's what it was. It was a tenth, yeah. And so we looked at that and we're like, okay, seems like it potentially could be a real number, because they can't really fudge this stuff. They can, but SEC
But
filings.
it's interesting if they really do have that much revenue. So why would you say, well, here's a company
Here's why
that's
it's interesting.
got 1/10 of Apple's revenue,
Right.
but it's going to have 25% of Apple's valuation.
Right. So that's the crazy part, and they're a hiccup away from a major market reaction, right? Because I was looking at the numbers, the BlackRocks, the Fidelities, the institutional buyers are projected to make up 70%.
The usual.
Yeah. Okay. And so if you have all of these huge hedge funds and institutional buyers that are watching the numbers constantly, and they're saying, is this thing really going to grow at a steady rate? If there's a hiccup where Microsoft and Uber drop their contracts, and then all of a
Which they
sudden,
did, by the way.
yeah, and then you get another player that drops a contract. Well, now, what if the guidance changes and it's like, well, they're not doubling their growth rate; it's only growing by 60%.
By the way, for our listeners, explain guidance briefly.
Guidance just meaning they're issuing statements on where they believe they're going to land
The company
financially
itself
for the
is
next.
suggesting whether their profits are headed.
Right.
So the company is doing the guidance on this one. This isn't an analyst that's
Mhm.
there. It's during earnings calls. The company says we expect our earnings to be at these levels.
Right, and so I'm just in the back of my mind, what if they have a couple bad, forecasts? The market could shed in a huge way. Like sellers could show up left and right. I got to get rid of this. I got to get rid of this. I have 100% profit because the share price went up like crazy in the first 3 months, and I got to lock in my gain. And if there's a bunch of panic selling around it, I mean, would it be crazy to see the share price, drop 50, 60, 70%?
It's
it happens all the time.
opposite of the GameStop phenomenon.
Yeah.
Right? If everybody wants out and nobody wants in, the price collapses. If everybody wants in and nobody wants out, the price skyrockets.
Mm-hmm.
So it has to do with how aggressive the buyers and sellers are is part of what drives the short-term movement. And so that's the issue here that's really hard to understand, is that there's fundamental data, meaning there's math that we can look at and say, well, the company earns this much, the company spends this much, this is how much is left, so this is how much, if you liquidate all the stuff that they own, this is sort of what it's worth. There are ways that you can extrapolate what a company might be valued at, the sum of its parts or whatnot, but then there are ways that the marketplace is deciding what it's willing to pay for shares at any given point, and they don't always align. And that's the tough part right now, is some of the historical ways that we look at investments. Okay, let's talk about one of the most common of all, the price to earnings ratio.
Mm-hmm.
This is not commentary on whether or not this is a good indicator. It's a common indicator, but it's not necessarily good, nor is it bad.
Right.
It just is right now. But here's what you would look at. Let's say a company has a certain number of shares, and we determine the profit per share, and we say, oh, well, the company makes $1 of profit per share, and the cost per share is $100. The price to earnings ratio would be 100 to 1, right? So PE ratio 100.
Mm-hmm.
Okay, if the company's stock price was $5 and it made $1 per share, it'd be 5 to 1. The PE ratio would be 5. I think I'm doing that right. But what happens is you're making $1 for every $5 of investment versus making $1 for every $100 of investment. That's the idea behind a PE ratio. So when you see a PE ratio of 50, what that says is I have to put $50 into this investment for it to return $1.
Right.
If I see a PE ratio of 10, I put $10 in for a return of $1. If we were doing yield calculations, it would be really simple. We're not,
Yeah.
right? But this is where it gets a little weird. What if the company's not making money?
That's
Like
where it
SpaceX.
gets really hard.
SpaceX is burning through capital right now. So if you said, well, what's their PE ratio? It says it doesn't exist because there is no earnings. Now that's not the same as revenue. They might have revenue.
Oh, yeah.
But they
and-
spend more than they earn, which means there's no earnings.
Yeah, it's crazy. I think I was telling you this earlier. SpaceX inked a deal with Anthropic, so now they're working together, right?
Sure.
And Anthropic is like, hey, we need a ton of compute ability because everyone wants to use AI to code now, and you have the world's largest supercomputer. We're going to pay you $1.25 billion per month to be able to use your compute power. Over $1 billion a month.
Yeah.
That's crazy spend rate. That's nuts for companies that haven't even gone public yet. Massive
That's
deals.
wild.
Yeah, it's crazy.
The numbers are staggering, and this is why we get to the comment from the beginning of the show.
Yeah, exactly.
The math is
Loop
hard.
it back. Yeah.
Right? The math is hard, so let's bring this around. Matt,
Mm-hmm.
why is the math hard? What's the hard part about this? That as an investor, or and right now, we're professional money managers,
Mhm.
in addition to being financial advisors here. So, what do you see as a challenge?
Here's the challenge. You have to weigh, as an employer, right? If you're a business, you have got to ask yourself, what's the best investment of my money? We saw Microsoft ditch their deal with Anthropic and saying it's too expensive, we're going to use internal products. Uber burnt through 12 months of their AI budget and 4 on Anthropic. They're like, we can't afford this. And so what we're seeing is some of the big companies are already, before AI really takes its leaps and bounds, they're walking it back and saying humans are cheaper. I can hire someone to code cheaper than I can buy the credits for through these AI players. Energy's expensive. Electricity's not cheap.
Mm-hmm.
You're paying tokens. I can just go hire someone
Yeah.
and get the job done for less money.
Let me give our listeners just a very brief insight into what's going on here. AI is graduating from what would be considered intelligent prompting, where what you do is you ask the AI to behave in a certain way and then answer questions in that behavior form, to acting as an agent on your behalf, meaning ask it to do a task and it will figure out how to do the task.
Mm-hmm.
Those are really different things. Well, the way that the AI is using compute power is in what they call tokens. So when the AI needs a certain amount of compute power, it takes a token to do it. And I'm oversimplifying here, but that's okay. The point is still going to work out. A really complex task takes more tokens. If you ask AI to figure something out, it will figure it out. And what happens is it becomes a little indiscriminate about its token usage. And if tokens are the equivalent of spending money, which in effect they are because there's both power and the way that these AI companies are billing is they're saying, I will bill by the token and you'll pay per token for usage. So now you have this complex system burning through cash, essentially, in order to operate. And I think what Microsoft is figuring out is, we have other tools that we can use for coding and assistance that are cheaper to use. And when we give the AI the run of the place, it doesn't control costs as well as a human can.
Mm-hmm.
So it was cheaper for them to keep humans in the loop than to just let the AI sort of go Girls Gone Wild or whatever.
Yeah.
Can you even say that on the radio?
I think
don't know.
you can.
But everybody gets it, right? It's like at some point you're like, oh, well, we're just going to throw all the rules out and who cares what the behavior is. Like, oh, happy to you.
Yeah.
Right? That's where the bad stuff happens. So, yeah, that's the issue that we're starting to see is that companies are saying, we are not going to just give a blank check to the AI ecosystem
Right,
and
'cause-
let it run wild because it lacks something really critical. We talked about this too, right?
Yeah.
What happens when
just-
you give an uneducated teenager a credit card?
Yeah.
Bad behavior.
Yeah.
They lack discernment.
Mm-hmm.
And that's the problem right now is AI, it will solve the problem any way it can conjure it. It doesn't necessarily know how to solve it best,
Or the right way.
the right way.
Yeah.
It basically, it can just kind of run with it. And all I can caution is every time you hear somebody says, oh, AI is amazing, it does all these things. So, okay, but what are you selling? The people selling you AI tell you AI is amazing and it does all the things. If they're using AI and they tell you it does all the things, now you have my attention.
Yeah.
But if you're just telling me I need it because look at all the things it can do, so what's it doing for you? It says, well, it's telling me how to sell it.
Mm-hmm.
Interesting.
You know what's crazy is even now, like you start reading some articles and you can tell now, or at least I can, when it's an AI generated article, and I'm seeing so much error in it, like graphs that are being published, and I'm like, the market wasn't down that year, like the graphs are off, and I'm like, I feel bad for people that don't know because they're just reading this stuff blindly, and I'm like, that's garbage. Like none of the stats are even accurate, and so I think there's a lot of misleading info
I'm
out there
smiling
too.
because do you remember probably a year and a half, 2 years ago what I would say about AI? There's 3 types of people with AI. Do you remember those 3 types?
Yeah, one of them was like you've got the one person that's gonna use AI and become like much more proficient and successful with it, and then I don't remember the middle one, but the last one was basically then there's going to be the person that uses AI, they don't really know what they're doing with it, and then they're just going to be in worse off trouble because they used it in the first place.
There's the people that they're so bad that AI actually makes them look better, right? It actually improves outcomes.
Mm-hmm.
There's the people that use AI really well and they become experts. And then you have people in the middle that rely on AI indiscriminately and they go way faster down the wrong path.
Yeah.
And that's the thing that we're starting to see, and you just illustrated it.
Mm-hmm.
Anyway, I'm looking at the clock, we're running long. Let's do this. Let's grab a break, and we will come back on the flip side of this, where we have got to figure out how, as investors, we need to look at value, not just individual companies, but at the marketplace at large. What might this mean?
I like it. Let's
Stick
do
around.
that.
I'm Dave Littlejohn.
And Matt Dixon.
And I'm Lauren.
And you got True Wealth on News Radio 93.9 FM and 1240 KQEN.
So fascinating.
You can just talk if you want to
I
also.
can, yeah.
You're like,
Well,
I'm
like
just
I
listening right
have
now.
questions, and I feel like you feel the question, so you ask Matt. You're like, explain that one, and I'm like, yes, please.
Well, ask the question. Feel free to, at some point,
Yeah,
if you just want to like,
sounds
you
good.
know, I have a question. I'm like, great, I'm glad you did.
Yeah, but I'm just fascinated right now.
Well, I tend to gravitate to Matt not because I like him more, but because he's the one on camera. So on YouTube, you're coming from like nowhere land.
Yeah.
Where Matt is not.
It's true.
And it works great on the radio, but you don't have a microphone yet either. which
Yeah.
Maybe we should put on our list, get additional microphones.
Do we not have a third?
No, it's a 2-packer. So we need
Oh.
a second system so that we have a 4-packer.
Oh.
And then we could cover everybody for
There you go.
the shenanigans.
Nice.
Because even if we couldn't see you, if you were a voice from beyond, it would still make it cool.
Voice from beyond. Yeah.
Well, you definitely need to be mic'd because you're you're a very soft voice from beyond.
You could fit 3 of these side by side on there, because there's a lot of dead space. Like that's all dead space. That's dead space. That's dead space.
Sweet.
Yes.
Yeah, this is super fascinating though.
It's there's a lot going on right now.
Yeah.
It's wild.
Well, one of the things I would like us to get into in this next segment, Matt,
Yeah.
is the macro impact of this. And, you know, what if the math changes? You know, how's it going to get applied? Because we just started scratching the surface of you know,
Yeah.
what if AI's more expensive than humans? And then the whole robot conversation, too, about we're telling everybody it's all going to happen, but will it, does it, can it? We don't know about ongoing costs of robots.
Yeah, so I guess maybe this is a question for the show, but here's one to think about. Could you get to a point where the cost, I know this sounds like you're going to say no, but do you get to a point where the cost doesn't matter because the companies have already spent so much and they want to win the race that they're like, you know what, we know that the humans are cheaper, but screw them. We want to win at the race. We don't care if we take a little bit of a profit loss for the next year or two. We're going to go the AI route because eventually the cost of it will come down when energy prices come down.
So, I love the question, and it can be. I want you to ask it on air,
Okay.
okay?
Be mulling around
It's
your
a-
answer.
It's a good question.
I want you to ask it on air because
First,
there's-
you pose the idea that, here's my wild idea, you know, that we,
then I have to
we-
remember your question. I
Oh,
already forgot.
listen. Okay, I'll just keep it locked in.
Because I think you did write it down. You're like, I have this question. Here we go.
Okay.
All right, gang, welcome back to the True Wealth Radio Show, where we got a whole group of us in studio. So Dave Littlejohn with
Matt Dixon.
Ann.
I'm the art.
And Emma is she's gonna ask other
Hi.
questions. She has
Yes, I am.
questions, right? And then she's like, I'm just fascinated though. I'm just listening. I'm like, no, chime in. But Matt, you were gonna kick us off.
Yeah.
So we've just talked about the markets at large. We've talked about how valuations can be expanded or contracted rapidly, and how AI is this huge swath of the market, and that suggests that it could either increase or decrease the big chunk of the market quickly.
Yep.
So, what does this mean?
Yeah, we were kind of left people hanging with this concept that, you know, Uber and Microsoft are looking at humans and saying, well, you're cheaper, so we're going to cut some of the budget or reroute our spending on AI.
Mm-hmm.
And so I guess one of the questions I'd have for you would be, do you think that a lot of companies kind of ignore that fact and they say, you know what, we know that humans are cheaper, but we're going to continue to go the more expensive route with AI because we want to win the AI race, and we don't really care what it costs. We'll be, you know, sucking on our profits for the next year or two, but that's okay. Let's still stick with AI because we want long term to go the AI route.
So there's this subtle thing that you said in there that I want to highlight.
Okay.
Because depending on which version of this, the answer changes.
Mm.
You said, would they just, I think you used the term sucking on profits,
Mhm.
but if you think about you're saying there's profits. So if the company has profitability,
Right.
would they stomach lower profitability in order to simply push the AI further?
Right.
I would suggest, sure, they could, because there's profit.
Mm-hmm.
And so at some point, investors expect return.
Yeah.
That's the whole point of doing it, right? If it's profitable, then you may be able to make the rationale that, well, we're buying market share, or we are trying to reinvest in some form of experimentation. So there's still spin available. I think if it's not profit, but rather deficit spending, there is a point at which companies can run out of money or can run out of investor support. And so that's different, because you can't deficit spend with money that doesn't exist permanently. Private sector doesn't have a printing press. I know it sometimes feels that way when you see these giant companies. It's like, where does the cash coming from? And the way it shows up is you bring more investors on by diluting the company, selling some shares privately at a higher valuation, because those people want in because it's closer, right?
Mm-hmm.
When the company's brand new, scary, might not make it. But now we're way down the path. Look at all this infrastructure we have. We're this much closer. The company's going to get IPO'd pretty soon at a huge value. It's not too late for you to get in at a cheaper point.
Yeah.
And so more investor dollars flow in. And the key is sometimes the company gets diluted. It's not like, well, there's 10,000 shares of stock and that's it. It's like, no, there used to be 10,000. Now there's 20,000 or 50,000 or 1 million. And so you just keep printing new shares. The existing shareholders get diluted, and the new people buy it at a higher value.
A lot of people don't understand that about the investment landscape, and I think it's really worth monitoring when you go to look at a company. Like, what have they been doing lately? Are they doing a bunch of buybacks where the company is actually buying shares back to then increase the
right, which would rarely happen pre-IPO.
Yeah, exactly.
Rarely would that
Right.
happen, because what that would suggest is the company's not headed toward IPO. That company is instead trying to stay private.
I'm speaking like non-IPO companies that are just out there. They've existed for 10, 15 years, and it's like a lot of people don't think about that though when they're investing in long-term companies.
Correct.
Yeah.
Correct. So anyway, that's why the question's fascinating too.
Mm-hmm.
Because if it's profits, they may choose to reinvest to buy market share, maybe to outweigh somebody else that's burning through capital, and maybe they fail, so they're just holding their breath longer. There are lots of strategic reasons that could happen. But if the company is not making money, there comes a point at which shareholders get impatient.
Mm-hmm.
And we don't know that point yet. Right now there's still a frenzy for AI. But what this reminds me of is the dot-com era, when everybody had to get in. And it didn't matter how stupid the idea was, throw money at it, it's going to print more.
And for a while, that's the crazy thing.
And it did until it didn't.
Yeah.
And that's the issue with the AI that I see is I'm just willing to be a pessimist on this.
Are you the first monkey to jump off the carousel or the last one?
Yeah, I don't know. I'm not jumping off the carousel per se either. I am very cautiously watching and saying these numbers, as they continue to get more and more comical, suggest to me at some point, I've said this for years, trees grow toward the sky, but not to the sky.
That's a good way to say it. Yeah.
And so that's the issue here, is that there comes a point at which the valuations are unsustainable because investors look at this and say, okay, SpaceX, let's just theoretically, SpaceX IPOs, it's a $20 trillion company. It represents the entire US GDP and it's not making money. And you have to look at this and say, how can they possibly
Give me
earn
the
enough
narrative.
revenue to be worth that? Ever. You know, and it's like, well, they're just, Elon Musk is going to invent something else. I'm like, Elon will not live forever. Okay? He's in his 50s now. So I'm like, do you expect him to live for eternity? It's like, well, he's going to Neuralink himself into an AI computer and he'll just keep going. Maybe. But and then he's going to ship himself to Mars, right? So it's just like, it doesn't make intuitive sense that it would go forever. And ironically, I bet you that if he were in here, one, he'd be like, why am I talking to you? You're nobody. But two, he'd go, no, that's ridiculous. Nobody lives forever. He'd be the guy to say it. But investors are like, no, there's got to be a reason to be optimistic. We're going to find a reason. I'm like, at some point, the valuation is just stupid.
Yeah, we'll see where the final numbers land. It'll be interesting to see.
It will. So
Just get out your popcorn. You know, like
Yeah.
we're about to have a show.
Well, the thing that concerns me is once the tide starts to go out, that was the problem with the dot-coms, is once somebody got the idea that this was overbaked, it was like watching a sweater unravel.
Mm.
Like they just started pulling that thread and it just kept going and going and going. Before you know it, there was no more sweater. the NASDAQ fell like 80%. That means the value, when you look at in aggregate, all the different stocks, 80% decline. Didn't mean every stock fell 80%. A bunch of stocks stopped being stocks. Like there's wall art somewhere of companies that used to exist, and you can see the shares of what used to be.
Yeah.
And there's a bunch of NASDAQ stocks from the 90s on that list.
The graveyard of stocks.
Exactly. So I still believe that investing is not the same as speculating, and so I am very aware and cautious when you start to see valuations, especially when everybody starts telling you, oh, it's time to get in for whatever reason. Like,
Mhm.
well, okay. But when you get that kind of sentiment hype around something, rarely is the market right. Like, rarely does the mob get it right.
Mhm.
That's my issue. It's like mob thinking is generally the lowest common denominator, not the other way around. So there you go.
I like your take.
So anyway, that's my take on it. Notice we're really sneaky about. I didn't pick a single position that I was saying it's going to go one way or the other. I was just saying, careful when things start to get really expensive. Maybe you should believe it.
Yeah, I think the biggest one too for investors to think about is don't put all your eggs in one basket unless you're willing to lose the eggs, right? Because it's like,
Or
hey,
the
if you want
basket. That's the thing that concerns me is everybody says, "Oh, I got a bunch of tech stocks." It's like, I got news for you. When you start to see 92% correlation across all those different assets, are you really diversified?
Yeah. Yeah. Mm-hmm.
So,
What would you tell, like, if you could just, I mean, you've been through a lot of market cycles, right? And you've
I
seen
think
the
you just called me
dot-com.
old
I
in the
think
most
so,
polite
too.
way
I
I've
think-
ever heard.
Yeah, I mean, you're rivaling Buffett here for the number of
wow,
dollars.
I call you really old. Got it.
You should see the camera. No. But so you've seen a lot of this stuff. What would be some kind of advice you would give investors who are in the market right now versus the investor that maybe has new money and they're like, I don't know what to do with this? Kind of, I mean, yeah.
Okay. We've got some blocking and tackling stuff to talk about.
Okay.
But I think what we do is I make everybody wait for this advice until after the last break.
Let's do it.
All right, stick around if you are talking about what do you do in a market like this. We're going to carefully, legally navigate without giving individual advice here, but we're still going to try to give you something to chew on. Stick around, we'll be right back. I'm Dave Littlejohn,
And Matt Dixon.
And I'm Art.
and you got True Wealth on News Radio 93.9 FM and 1240 KQEN.
That was honestly one of my questions, and I was like, that's advice. And then the other one's like, how do you know when you should jump ship or back away from said ship? But is
Well-
that advice too, technically?
So it's sort of advice, but I can answer it in a way that I think
Like I'm banging up.
doesn't nail it. So here's the thing about any position. It's harder when you already own it than when you don't. Okay? Because if you don't own something, you walk in and you look at it and you say, would I buy this today? And if the answer is, yeah, that looks like a pretty good deal, great. When you already own it, you have this tendency to say, well, I bought it at X price, and so now I have to decide whether or not I would sell it today. The funny thing is, I think everybody should walk in and pretend they don't own it yet. And walk in and say, well, would I buy this today? And if the answer is yes, then it's a great idea to still own it. If the answer is no, then the question is, well, why do I own this?
That's good.
Right? And if the answer is not as compelling as the answer to buy something else, then you really start to think about, how am I allocating my investments? Because I own something that I don't like as much as something else. And you have to know, well, do I not like it because I'm thinking short term or not? And there are some checks and balances that you should do to that. But if you generally like, no, I think the opportunity is better somewhere else, well, then you're not really leaving the marketplace to move from one investment to another. So it's not like, oh, I'm gonna. What you're really doing is you're gonna realize the taxes of your environment. Am I gonna end up paying capital gains right now, long or short term, in order to get into this other opportunity? And if I am, is the opportunity compelling enough that I still want to do it?
There it is.
So that's
it.
kind of the answer. But now for our listeners, and again, it's live on YouTube, right? I'm not that's still reasonable for any position is how you do assess it. But I would say to everybody that's getting this advice, air quotes, talk to a pro about it first. Like, this isn't individual advice. Your mileage may vary.
Yeah.
Welcome back to the True Wealth Radio Show on the home stretch. I'm your host, Dave Littlejohn, in studio with
Matt Dixon.
And Emma Art.
And we've gone through, today's been one of our favorite subjects, but today was why is the math hard?
Well,
Right?
we failed
Why-
math,
This is not true. Matt was literally a math teacher. So that could not be more inaccurate. If the math is hard because when you start getting speculation commingled with investing, it muddies the water.
Mm-hmm.
Right? And that's where we're at with a lot of AI companies. Is there's speculation. Anytime that you're putting money into a company that's pre-profit, you're banking on the fact that the profits are going to show up. You're speculating on that. It might be a very high probability, which means the speculation level is low. But ultimately, investing always has a little bit of speculation.
Yeah.
And the more speculative it is, the more reward is required in order to justify owning it as an investment.
I feel like there's a lot of speculation this go around, right? Because everyone's thinking, look, think how many people are going to show up to buy this thing. And if everyone's buying it, the price is going to go up, right? So just be one of the lemmings and get in line.
I think that's the key detail of this market, is that it appears to me that there's a lot more speculation than other historical markets.
Oh, yeah.
Not more speculation than ever in market history. That's not what I'm saying. I'm saying there have been less speculative times in the market than right now, especially in an outsized category,
Mm-hmm.
right? Artificial intelligence and the amount of market cap weighting to the major indexes that it represents right now that may be historical. I don't remember in the 2000 .com burst, the market being this disproportionately weighted to a specific segment of technology. Right? The NASDAQ was heavily tech weighted, but the S&P wasn't like
I
this.
actually think they said that in the entire history of any stock market ever, I think that the semiconductor space right now is as far as valuations go, we talked about PE earlier, just valuations as a whole, I think this is the second highest we've ever seen any subcategory of a market ever.
I wonder what the first was.
It was something over in Sweden or something, or it was a European country, if I remember right. There was some European segment of a market that had some huge explosion. So, yeah.
Which is kind of hard too, because if we look back, I remember it
was a really long time ago too. A
Okay.
really long time ago.
Well, that's harder to
Yeah.
parse. But the bottom line is that
Basically, in recent history, this is the most expensive any segment of the market.
it's expensive, and it's fascinating because it's really, again, it's very specific to one sector. It's not broad spread.
Yeah.
Right? It's not like everything in the marketplace is expensive.
No.
This area of the marketplace is really expensive.
But because of the market cap stuff that we talked about,
Right.
it just engulfs so much of the index, and that's where I'm concerned. The index has gotten so heavy in one area
Yes.
that I'm it's not really the index anymore.
Well, yeah.
I mean,
it's
it
funny,
is,
It's funny,
but it's
yeah,
not.
I know. It's not really a diversified haven as
No.
it's historically been sold as.
Correct.
Right. The formula that the index utilizes has lent itself in this circumstance to overweighting in the area of the market that has performed best,
Yep.
which makes it very hard to outperform the index right now. But it also means that if something goes wrong in that sector,
The burn is worse.
yeah,
You like-
yeah,
it's like,
there's
oh.
concentration risk right now in the index, and that's not how I think they've been pitched to a lot of people.
No. A lot of people are like, look, I'm so diversified. I own 25 mutual funds over all these indexes. I'm in everything, so I'm good. And then it's like, well, let's get behind the numbers here. You really basically just own the S&P 500, which means like 40-something% of your money is just in tech.
Yeah. So
Yeah.
let me help people out. You asked for some quick advice,
Yeah,
like
yeah.
a hot take on what do people do in this market. The first hot take is that everything I'm about to say is not to be considered individual investment advice. I'm going to give you some strategic things to think about, and then I'm going to encourage you to seek a professional, and this is your mileage may vary kind of stuff. That's just the nature of how we have to do this. So none of this is actionable specifically for you, but think about it. Okay, the first is that in a market that's really concentrated like this, one of the things I would encourage you to do is encourage current valuation, to review the current valuation of something in the sector that it's in relative to historical valuations. Does it seem more expensive than it has been historically?
Mm-hmm.
That's something to consider in your math. The other is, how concentrated are you in a specific sector? We just discussed that and what that would mean. Okay, so one of the things that you can do, and there's a lot of free data around this, especially because many of you own mutual funds, is I want you to go and look for something called R squared. Okay? You don't really need to know what that stands for or anything. It's a statistical measurement, and what it's looking for is it's trying to explain how much of the underlying movement in your investment can be attributed to its benchmark. So most of the time we're benchmarked against the S&P 500. If you have an R squared of 0.92, then that would mean 92% of the movement in your investment can be attributed to the S&P 500. Okay? Is it a rock solid fail safe? No, but it's a really good indicator of whether or not you think you own a diversified mutual fund, but you may be owning a phantom index and just overpaying for it because you're paying a manager extra to basically buy the S&P for you. So that's another thing. Now, if you've already got a bunch of cash in the markets, one of the things that you should look at is, should I be potentially rebalancing to avoid being overweight in a category? So that's the thing, is consider, am I risk appropriate for my master asset allocation? And if you have a bunch of money and you're trying to figure out whether or not to put it to work, one of the things you ought to consider is, do I dump everything in all at once, or do I spread it out over time and average my cost into the market? What this does is it avoids entering the market all at once just in time for the markets to roll over and go down. Okay? It reduces your returns to the upside, but it does so by reducing your risk exposure to a single volatility event. So those are all classic things that you can do. Another consideration, if you're interested in preserving principal, is to reallocate your account more conservative and then take the interest that it's earning and use that to dollar cost average back into the markets and become more aggressive all over again.
That's a good one.
Yeah,
So these
that
are
is good.
all just classic blocking and tackling strategies for managing risk in your investment strategy. Beyond that, there's some tax management that you can do that would probably create a little bit of extra juice. We call it tax alpha for strategic buying and harvesting losses against gains. But those are the biggies, and what I would tell you is go talk to your financial pro about how you could accomplish those. And if you don't have one, hey, we know somebody, Matt. Who do we know?
Us, 541-375-0898, and the name is Little John Financial.
All right. Well, I'm looking at the clock and we're out of time. So thanks, as always, everybody, for tuning in. Until next time, I'm Dave Littlejohn.
Matt Dixon.
And MR.
And you've been listening to True Wealth on News Radio 92.9 FM and 1240 KQEN.